following reports over the weekend that Trump announced a preliminary agreement has basically been reached with Iran. Oil prices experienced another plunge at the start of this week. This indirectly suggests that the market is poised to move past the distractions of the Middle East situation for the time being. Barring any new black swan developments, the focus this week will likely shift toward U.S. inflation data. U.S. President Trump posted that a deal has basically been reached between the United States and Iran, pending finalization by both parties and relevant Islamic nations. The final steps are currently under discussion and will be announced in the near future. Saudi media reported that a preliminary agreement between the U.S. and Iran will be reached soon, with the next round of talks potentially held on June 5. According to reports, the preliminary agreement that may be reached between Iran and the U.S. will be known as the Islamabad Declaration. On May 28, the latest U.S. PCE data, the Federal Reserve's preferred inflation gauge, will be released. Due to U.S. inflation data exceeding expectations and the stabilization of the labor market, the full-year PCE is expected to be significantly higher than the 2% target, making it difficult for the Fed to cut interest rates this year. On the same day, the revised annualized quarter-on-quarter real GDP for the first quarter will also be announced. WTI crude oil formed a bearish outside engulfing pattern last week, which, coupled with a technical breakout, signals an accelerating downside trend. Following the release of critical news over the weekend, oil prices opened significantly lower on Monday and may further test support levels toward the 80 mark this week. With the breakdown of the triangle formation, oil prices are expected to remain under pressure in the short to medium term until the market finds a new equilibrium in supply and demand. Resistance on any rebound is expected near 97. Barring new developments, further upside is likely limited. However, bears will face significant challenges if they attempt to penetrate the major mid to long-term support levels at 80 and 70. Gold experienced limited volatility last week, and while it closed slightly lower, it failed to decisively break below key support levels. Following the release of recent news, gold prices saw a gap-up rebound at the start of the week. However, whether this rally can be extended depends on the battle for resistance at 4,773. Only a breakout above this level and the previous high of 4,891 would provide an opportunity to fill the gap above 5,000. Current support remains near 4,501. A break below this mark would lead to a test of at least the 4,400 level, with the potential for further declines toward 4,280 or 50. Nevertheless, whether the low near 4,100 will be breached requires further observation. The US dollar saw an exchange between bulls and bears last week, ultimately forming a small doji star, followed by a gap-down open on Monday in tandem with falling oil prices. The battle for the 99 level remains the core driver of recent price action. Although the news environment is unfavorable for the greenback, its resilience appears significantly stronger than that of crude oil, suggesting that the current sideways volatility may not end quickly. Initial support is seen at 98, but only a break below the long-term trendline at 97.5 would signal the start of a genuine downtrend for the US dollar. If the bulls can hold firm above 99, the opportunity to test 100.5 remains on the table. USD/JPY continued its rebound last week, closing with a small bullish candle. However, progress at these relative highs has been sluggish, clearly reflecting trader concerns over potential foreign exchange intervention risks. The outlook for this week remains unchanged. The primary focus is whether the pair can stabilize above and break through the 160 mark, though the risk of intervention by the Bank of Japan persists. Bulls are expected to maintain a relatively cautious stance. However, as long as the pair remains above the long-term trendline at 155, there will be no immediate pressure or risk of a further drop toward 151-152. From a medium to long-term perspective, fundamental factors remain primarily bullish, and investors may patiently wait for pullbacks as opportunities to go long. Bitcoin rebounded last week after probing lower and testing the critical 74,000 support level, with shifts in news over the weekend providing additional support. Only a break below this level would subject the price to further downside pressure. However, as long as 60,000 remains intact, an accelerated decline is unlikely to occur. Regarding the rebound, the focus is currently on the battle around the 80,000 mark. If Bitcoin can establish a position above this level, it will reopen upside potential. That said, the peak of this current rally is expected to remain within the 90,000-100,000 range, rather than signaling a definitive transition from a bear to a bull market.